today's lecture, we're going to continue and wrap up our discussion of topic 3, part 2, which, if we recall, is implementing comparables-based valuations for valuing startups, where we are taking an exit comparables approach and using that to get an exit value conditional on success that we can then plug into VC method in order to get a value of the company today. That is our broad strategy. And so far, we did this in 2 ways at 2 different points of the life cycle for Dropbox. The first one was super early, where we have almost no information. Because we have almost no information, we really don't have a basis to try to forecast an attribute. So we did what I called an unconditional exit comparables-based valuation. That was our valuation of Dropbox as of September 2007, which was slide 11 out of 26 in our current set of lecture notes. That was the first implementation of a comps-based valuation that we did last lecture. Then we ended the class last lecture doing one other valuation, but there it was conditional. And when I say conditional, what I mean is we forecasted an attribute so that we would take our terminal value as the terminal forecast of our attribute times our terminal multiple obtained using exit comps. And then we plug that into VC method. And we did that with our October 2008 valuation of Dropbox. Right, so we've done, and by the way, that it starts to get a little bit cumbersome in terms of terminology, but I swear, like, each part of the terminology is about categorizing what we're doing, right? But the second valuation we did with Dropbox was a conditional exit comparables based valuation with top-down forecasting, because the way we had forecasted our exit revenue for Dropbox was by going top-down, where we started with an estimate of the overall market, which we piggybacked off of the market forecasts of consultancies that specialize in sizing markets. Makes our life easier. If I don't need to size the market, yay, I have less work to do. And so that's what I did with Dropbox. I used the forecasts of one of these go-to professional consultancies that size markets, which was IDC, used their numbers, and then all I had to do to forecast my exit revenue was to forecast my exit market share if I'm successful. Where when I say I mean I as in Dropbox. Right, and then I gave you guys an argument for my exit market share conditional on success as well, but I won't rehash that here. And it was the product of those 2 numbers, market size at exit times market share at exit if I'm successful. It was the product of those 2 things that gave me my exit revenue if I'm successful. So far, so good? Look, there's 2 broad strategies for forecasting revenue in the future. This is true in our setting, but it's true in any corporate finance setting. You can go top down, which we've just discussed, or you can go bottom up. Where bottom up is you kind of use more projections that are internal to the company, right? Hey, this is how easy it is for me to get customers recently. And this is how much it costs for me to get them. And this is how many people are available in the channel that I'm currently trying to tap right now, yada, yada, yada. But it's all about seeing internally, how are we getting customers and how expensive is it? How successful is it? So it's about projecting our historical experience. We can see, like, that's a totally legit way to go about doing this as well, right? You don't start from the overall market and zone into you. You start from all those little micro things you know about yourself, and you try to extrapolate from that. That's the second broad strategy, and that's called bottom-up forecasting. This is what we will be doing and focusing on next, is instead of doing a conditional exit comparables based valuation of Dropbox with top down, we will now think about, well, what if we do Dropbox going bottom up instead, which is extrapolating off of their growth trajectory so far. Now, I hope you guys understand, in order for us to do that, we need to have enough history within Dropbox. If Dropbox launched yesterday, good luck extrapolating, right? Well, in October 2008, which was the valuation we did at the end of class last time, I mean, Dropbox had officially launched less than a month ago. So I think we can all understand that going bottom up there would have been complete bullshit. That's why we didn't do it. That's why we just focused on top down. Because usually you can do top down before you can do bottom up. Because when a sector starts to get hot, the consultancies start to study the sector. And they study it by doing surveys of potential customers and things like that that can substitute for internal history. You see what I'm saying? And so there's a natural life cycle that happens here, which is that you can start doing a credible top-down forecast before you can start credibly doing a bottom-up forecast. That's a big deal because remember, I said at the beginning of this topic that there is a life cycle of valuation. This is getting to the heart of it. Super, super early, the consultancies aren't doing shit yet either. So you can't even forecast at all. You go unconditional. A little bit later, consultancies are studying it, but the individual participants in the market don't have enough operating history to do a bottom up. So you only do a top down. And then a little bit later, now you have enough operating history for some of the companies in the industry. And so you can start doing bottom up. Now, bottom up is not perfect. So usually later on, you're doing both a bottom up and a top down because you can do both. And then eventually you have even more history so that you can actually project more than just revenue and you start building a full DCF model. So later on, once you get to substantially later stage, you're doing the comps, both top down and bottom up, and you're doing DCF stuff. And that's how this stuff evolves over time. All right. So that's, to me, like that's something you want to internalize because what it tells you is the strategies that you use when you do valuation on planet Earth, it's not one size fits all, but it makes sense. It makes sense on the basis of the data that you have available to you, right? So that's what I mean by life cycle evaluation. We will continue to do examples on different snapshots of that life cycle, in particular with a focus on exit comparables based valuation with bottom up forecasting. And we're actually going to do 2 rounds of this for Dropbox today. Those are going to be our examples. Sound good? Let's go ahead and do it. Let me first start. We'll be toggling back and forth between my slides and my spreadsheet. And again, I want to emphasize every single thing we are going to be doing today is using real data from Dropbox. Can everyone see my slides now? All right, perfect. So this was the example we did last lecture. So I'm going to just zip through this and go to our next instance of Dropbox valuation. So last time we were October 2008. Now we're 2/3 of a year later, June 2009. By the way, Dropbox is not raising funding right now. There's something else that's happening. Now, if they were raising funding, they would be viewed as a typical Series B company here, just so you know. They've been doing awesome, like crazy awesome. Like the growth story from October 2008 to June 2009 for Dropbox, and it continues thereafter for a while actually, is legend stuff. It is legend stuff. Dropbox has had spectacular growth, mostly via viral customer acquisition because of their referral program, where you invite a friend to join Dropbox. If they join Dropbox, you get just a tiny little bit more like memory that you can make use of in your online storage. It's incredible how well they grow via this channel. There's a lot of brilliant things in what they did, and unfortunately we don't get to do justice to that. If anyone is ever interested, I am available to talk about that. Again, I feel like I actually have the inside scoop just because of the accidental, college semi-friendship. So I've talked about these things with Sujay Jaswa, who, as I said, I've mentioned before, was the first business hire at the firm. They have reached 4 million users at this point. 4 million. Last time we checked, it was 100,000. I don't believe I'll ever see a company where that happens, where I actually know someone at the company. Let's put it that way. This is not normal stuff. Now, by the way, most of those users are not paid users. 2.5% of the users are paid. 97.5% are free users. By the way, a free user means a user you're kind of losing money on because you have to pay money to service them. Okay. When this happens, large companies notice. So literally what happens at this time, Steve Jobs reaches out to Dropbox and says, Apple is interested. Throws out an initial number. I don't know. Look, honestly, I don't know the number because I don't ask that kind of sensitive data, even to people I know. But I can tell you that there are rumors of the number. Rumors of the number are $700 to $900 million as an entry thing. Now, you might remember they raised money 8 months ago at a $29 million post-money valuation. 700 million. Most human beings would be like, oh my God, I am set for life, baby, right? You know what Dropbox does? They say thanks, but no thanks. They don't even pursue a serious negotiation because that's an entry point. If someone comes to me at 7, I feel confident I can get it to 1.1. Okay, 1.1 is a bit ad hoc of a number, okay? But I know I can get it up, even if it's Steve Jobs. And they say thanks, but no thanks. So, look, that means only a couple of things, right? It's either those folks are batshit crazy, or they believe Dropbox is worth more than that. Now, okay, there's this third possibility. They know it's worth less than that, but they really value controlling the mission. That could be another thing. But I think there's a limit to how much you value control. Am I willing to give up? I mean, if I'm about to become a member of the 9-digit club, maybe I'm willing to give up 50 million to keep control. But I'm not sure I'm willing to give up, 300 million or something, right? So it's probably not control. Trust me when I say Drew Houston and Arash Fardosi are not crazy. So they actually believe that they're worth more than 700 million. So here's what we're going to do now. We're going to try to get into the mind of Drew and Arash. We will try to understand what must they believe to say no to Steve. That's the point of this exercise right here. So let's go ahead and do this. And we are going to do this, as I said, exit-based comparables valuation, conditional style, where we forecast our revenue, now using bottom up instead of top down. Most of what we're going to do is going to be very similar to what we did in the last exercise. The only real difference is going to be how we forecast revenue. Sound good? Now let me change my share. I'm going to start sharing instead my spreadsheet. Can you guys see my spreadsheet now? All right, good. Let me go to the right date, June 2009. So this actually is pretty indicative of what I do when I do valuations on my non-day job, which is not being a McGill professor, but doing a little bit of consulting stuff on the side, which is if I'm asked to do a valuation, I do more than one valuation. In particular, I do a valuation under different narratives. So actually, first of all, let's be clear, I never did this, but hypothetically, you know, if Sujay had called me at this time and said, Jiro, Apple just called. They're quoting 700 million. Is this like, does this make sense? What should we do? If that was the question I was asked, I would not actually send them a specific number because you know what? They know way more about Dropbox than I do, right? What I would do is I would send them more than one valuation. I would give them several valuations that have in the background different stories, different narratives. And I would say, if you believe this, you're worth this. If you believe that, you're worth that. If you believe that, you're worth that. And I'd let them pick what they believe because they're in a better position to think that than I am. Does that make sense so far? Let me show you the narratives I would construct for Dropbox. Actually, if I were to do this and I would actually do way more than the number of narratives I have here. So here I'm going to show you 3 narratives, right? I would probably do more like 30, but illustration purposes, 3 is going to be good enough here. But I promise, you know, I'm showing you this. This is what I actually do. I practice what I preach. Okay. So let's take a look at this. I'm going to give you guys some more data. But it's very parsimonious data. So I would actually like more detailed data than this in the real world. But this was the data that Dropbox was willing to share with me. So I had to do the best with the data they were willing to share. By the way, they shared this data with me before they went public, right? So, you know, when you're still private, you value your privacy. So I was just grateful they were willing to give me anything, okay? But let's take a look at this. What do I know about Dropbox at this stage? Their revenue run rate is 12 million. They have 4 million users. They have $10 million in cash, 2.5% paid. And at the time, the amount of spend per paid user is 120 bucks. So this is basically, yes?
It's Cornish. Could you quickly go over what you mean by run rate? You said 12% revenue run rate.
I mean, it means that they didn't earn 12 million over the last year. It's if they stay steady with their 4 million, they're going to earn 12 million over the next year.
Oh, gotcha.
Because they've grown so fast, they haven't earned 12 million for like half of the year. It's like they probably earned more. I don't actually know the number, but they probably earned more along the lines of like 4 million. Because like 1.5 million of those users have been acquired over the last month and a half. Right. So that's what I mean there. That's a good question. Apologies.
Got it. Thank you.
Good. Here's also some data that they shared with me about their user acquisition. So they basically launched with a private beta list of 100,000. And then 200,000 after 0.33 months. So they doubled in like a little bit more than a week. After 9 months, they were at 1 million. After 13 months, they were at 2 million users. And after 19 months, they were at 4 million users. So those were the numbers they were willing to share with me. Okay, so that's kind of what I had at the time. Look, I'm just going to give you guys some numbers off of these simple numbers. Again, in the real world, I would want more granular data. But for illustration purposes, this is good enough. All I do here is I say, look, you know, on a monthly basis, Doubling in a third of a month is the equivalent of going up 716% per month. Okay, this is a number that's big because of a low denominator, so I'm not going to put a lot of weight on that. Right? It's easy to double when you have one customer. It's tougher when you have 1 million customers. That's the point I'm making. So I don't put any weight on this, okay? Then I go and calculate, well, what's my average monthly growth rate from time 0 to month 9 if I go and I'm at 10x after 9 months? That's 29% per month. It's 26% per month after 13, and it's 21%, a little bit more than 21% after 19 months. If I calculate marginal, so instead of the average growth rate from 0, I calculate what is the marginal growth rate between month 9 and month 13. It's 18.9%. Between month 13 and month 19, it's 12.25%. Simple calculations. These are easy calculations to do. So far, so good? Okay, useful to know. I'm going to get other data because this isn't good enough for me. So what other data can I use to try to understand what growth under success looks like? Because remember, when we are forecasting revenue here, we are forecasting revenue conditional on success, correct? Because when we use VC method, it is exit value conditional on success. Yes, no, maybe? Let's go with yes. So what other data am I going to use? I'm going to use data of successful SaaS companies because I have that data set. So let's go back to our old SaaS data. Well, we used to go up to 2008, but now we're going to go up to, well, okay, up to 2009. It doesn't add a lot of data, but we're still using it. I'm almost wondering if I have a typo. This might be 2010 instead of 2009. I'm going to have to look at that later. It's possible. I do typos periodically. I write these notes when my son may be like jumping on my head. So it can happen. It's like, I wish it was not true, but it's true.
Jiro.
Yes.
Could I ask a quick question here, please?
Of course.
At what point when you're valuing a startup, so say in this case, you have like the SaaS data and it goes from goes back to 2004. When do you, how do you judge whether you have sufficient data in terms of quantity to make a meaningful judgment based on that data? And is there a cutoff point, or is there any certain things you look out for?
Yeah. So, I mean, to be honest, with this data set, because SaaS is so new, I'm just going to be honest. I'm in beggars cannot be choosers mode. I use what I've got. Is it perfect? No. But can I do better? Not clear to me.
But so I get that. And I remember you highlighted that last time, but at what point is it wrong to draw conclusions from that data? How do you know? Because it's so limited and you don't have much optionality, where you're at a point where it's better to say the data is not available than make a judgment based on the existing data. How do you get some kind of indication on that?
Look, I mean, the answer is, I accept highly imperfect data if I've got no other data to work with, right? So yeah, I mean, we're going to get a number. I don't take it too seriously, but I got to get a number, and it's the best number I can get. It just means I come in and I'm not going to be like a pompous ass about the number. Because I know, I'll listen to your alternative perspective and see if it moves me. Right? Right? Meanwhile, if this was the most perfect data set in the history of the startup ecosystem of, the entire galaxy, then maybe I would come in and be less flexible. Right?
Got it.
But I got to get a number. Then I think using all of that data is going to get me the best number. Not the best number as in the highest number, the best number as in the most credible number. Right? But here's a nice thing about this data. So this data comes from IPO prospectuses when these companies went public. And those prospectuses include historical financials that allow us to get the revenue growth over the 2 or 3 years prior to going public. It's the 2 years prior to going public. So that should give me a sense of what conditional and success growth rates look like, right? That's what I'm going to use this data for. So far, so good? All right, now let's go back. I'm using this data. So this is real data. I collected it, you know. You guys can check. Go look at the S1 filings, and you will see those are the numbers. So I'm going to do a couple of different narrative valuations. The only thing that really changes across the narrative valuations is things. That's actually, there's going to be two. You know what? I don't want to overtalk it yet. Let's do it one step at a time. Okay. We're going to do that. I always start with the simplest, most conservative narrative. Right. So look, as I said, this is a typical Series B, right? So if we go back to part 1 of the topic 3 notes where I had the rules of thumb for a Series B, when does exit happen? It was 4 years. So I'm going to be forecasting out 4 years. T equals 4. That's going to be the same across every single narrative. The first thing I'm going to do is the easiest thing. I'm just going to assume Dropbox is going to grow like the average SaaS company in its pre-IPO period. So if you look at that data, in the 2 years before going public, on average, SaaS companies grew at a rate of 92% per year in terms of revenue growth. So those are the last 2 years before exit. I'll just apply 92% for 4 years. Well, if I'm at a run rate of 12 and I grow at 92% per year, that means revenue at exit 4 years later is $163 million. So far, so good? Look, you guys can poke holes into this morning, noon, and night. I'm going to do it. This is not the valuation, I believe. But it's the simple, simplest thing I can do. It's the one I can explain to my son while he's jumping on my head. Okay? This is exit revenue, conditional on success. Then I calculate an exit multiple. I get my exit multiple from those SaaS comps. So the average of the exit multiples using the data from 2004 to 2009 was 8.3. So far, so good? Multiply them together, exit value conditional on IPO of $1.36 billion. But remember, IPOs are the grand slams. There are also acquisitions, and we need to model that into our valuation. It turns out for a Series B investment, following a Series B, if you track all the IPOs and all the acquisitions, the ratio of their value is 2.5 to 1 IPO versus acquisition. So on average, the acquisition is 40% the size of the IPO. So I just take 40% of the IPO number. Notice what I did with the SaaS data is 4 IPOs. So the number I get for that is an IPO relevant number. So that gives me value conditional on IPO. 40% of that is value conditional on acquisition. Then I probability weigh those two things using the same method that we discussed in our last class, where I am factoring the fact that 39% of exits following a Series B are IPOs, while 61% of them are acquisitions. So this number here is 39% of this plus 61% of this. That gives me 862 million. Put that into the VC method where I divide by 1 plus D to the power of T, where I use the D for a Series B. The D for a Series B is 0.5 to the power of T, where T is 4. That gives me 170 million. Remember, they have $10 million in cash. Add that in, 180 million. Done. Do you think this is what Drew and Arash believe? No, they're not that crazy. So this is a narrative. I guarantee you, if I was presenting them to them, they might not let me finish this narrative and they would say, next, this doesn't apply to us. And what they would say is, are you a fool? What the hell are you doing here? Why are you assuming that we're going to grow like an average SaaS company over the last 2 years before they go public when we've got 4 years left and we've been doing pretty well, by the way, Jiro? That's what I would hear. Move on to the next narrative. This is bullshit. So let's go to the next narrative. I'm going to inch up, be a little bit less, I'll be a little bit less conservative, but I'm still going to be too conservative. I have a clear belief in which of these narratives is most relevant for Dropbox. But here's the narrative here. I'm going to say, you know what? That IPO data for SaaS companies, that's only the last 2 years. So why don't I assume Dropbox is going to grow like an average SaaS company over the last 2 years? But you know what? Over the next 2 years, it's true. They've been doing pretty awesome. So I'll assume they'll grow pretty awesome in a continuation basis over the next 2 years. And in particular, look, their month-on-month growth over the last 6 months has been over 12% per month. I'll assume that they grow month-on-month over the next 2 years, 10% per month. So it's going down, but it's starting to stabilize. And they're still doing great, and they still have a long way to go in terms of milking that referral channel. So I'm going to say 2 years of milking it, baby. 10% per month on an annualized basis is growing 213% per year. So far, so good? So now, in growing my 12 million, I'm going to assume 213% per year for 2 years, and then that same old 92% per year for the final 2 years. Are we okay with this? When I do that, I get up to exit revenue, conditional and success, of $436 million. I still apply the same exit multiple, 8.3. That gets me to an exit value of $3.63 billion. But remember, that's the IPOs. So just like before, I ratchet it down to 40% of that, 1.45 billion for the acquisition. I probability weigh again, 39% of this, 61% of that. That gives me 2.3 billion as an exit valuation, conditional on success. Plug that into the VC method, 454 million. Add 10 million, 464 million. Starts to make a bit more sense. Still doesn't explain the decision of Drew and Arash, correct? You know what they're going to say? They're going to say, Jiro, you still don't get it. Damn, why are we wasting our time with you? Because we're not just going to be good over the next 2 years. We're better than any of these SaaS companies have ever been, right? So we're not going to grow like an average SaaS company the last 2 years. We're going to do better than that, man. So give us a bit more credit. I'll give them a bit more credit.
Jiro,
Yeah, yes?
super quick question if it's okay.
The what now?
Super quick question if you have a sec.
I do.
I'm not interrupting. So when you're looking at the acquisition following Series B, do you separate that according to SaaS companies? Or are you looking at all industries?
So the data I'm using here is solely SaaS companies.
Okay.
Because SaaS are proving to be a bit of a different breed by this point. That's why I've given up on using all tech.
Got it. Cool.
It's because you've got recurring revenue, which actually makes it easier for you to grow more. So that's why, like, I have now dumped the tech IPO data. I'm just like, this doesn't apply here. This is a different animal. And the market, the VC market understood it by this time. So are we okay so far? I'm going to grant Dropbox a little bit more cred now. I'm going to say, look, you know, those last 2 years, you're right. You're not going to grow like an average SaaS company. You're going to grow like an average top half SaaS company. So I take my historical sample, sort it by their growth rate over the last 2 years, and I'll take the average of the top half. That's what I mean by average of top half SaaS sample. That means if you sort by the growth rate, that historical data set, and you take the average of the ones that are above the median, right? That's the number I use. And then I calculate the multiple of just those companies, because since they've been doing that better, they're also going to exit at a higher multiple. Does that make sense? That is the only thing I change here. So this 213 is still the same as before. I just give them more cred. I go from 92% to 121%. And the multiple goes from 8.3 to 10.3. Make sense? Multiply the two together. Now you've got an IPO exit value of 6 billion. Take 40% of that, you get this number. Probability weight then the same way that we've done every step of the way, we get 3.78 billion. Put into VC method, 747, add 10 million, 757. There we go, baby. We got it. We understand. We understand why Drew and Arash said thanks, but no thanks. Now you might say, well, wait a second. I mean, that's pretty close to 700. You can probably get Steve to raise the number a bit. Like, why wouldn't you at least listen? So I can tell you a little bit about Dropbox at this time. They were hoping that they would be able to increase their percent paid to more than 2.5%. They were hoping to nudge it up to 4%. They had a bunch of ideas for it. They were like, you know what? We just launched a photo sharing app where people put their photos, it goes on the Dropbox, they hit their cap for the free account quicker, and they'll convert to paid. So they had a bunch of initiatives that they believed was gonna like increase their percentage paid number. So I also do a valuation where I move the percentage paid from 2.5% to 4% and see the revenue kick that you get from that. And if you do that, you get a $1.2 billion valuation in this narrative. So if they think they're going to up that number, you can start to see why they're just like, we're not even going to bother. Because something like that, Steve Jobs will say, look, I'm not going to give you credit for raising 2.5 to 4% until you show me evidence that you've done it, and you haven't done it yet. So like they would be at an impasse in terms of a negotiation, because Drew and Arash think they're going to go to 4%. Steve will say, you haven't done it yet. Well, I'm sticking at 2.5%. They're not going to come to an agreement. It's just going to waste everybody's time. And we can understand now why they walk away. Make sense? That's what happened. This is the narrative that I think is most applicable to Dropbox here. And it all kind of makes sense. So we now understand, by the way, every calculation we did here was doable in 2009 because we only use data that is 2009 and earlier. There is no forward-looking bias here procedurally. And I've laid out what the narrative is with, I think, a fair amount of clarity. And I think, you know, this is an easy narrative to defend for Dropbox at that time. It doesn't sound crazy to say, you'll continue your hypergrowth for 2 years and you'll be higher than normal SaaS growth over your last 2 years. That's not crazy speak. That is like totally like sensible speak. Right? So if I was Drew and someone was trying to buy me for less than 750, you might have seen how animated I was getting earlier. I would get that animated and say like, you're nuts. No, like if this is how you think, we have nothing to talk about. Because it's like totally, totally sensible. So yeah, there we go. That's our June 2009 valuation of Dropbox. Look, again, we would have more data in the real world to get even a little bit more granular, but it's actually pretty cool. You do these numbers and you totally understand a decision that to most outsiders sounds crazy at the time. Because literally, I'm sure TechCrunch wrote about this, right? I'm sure TechCrunch was like, whoa, you know, what are they thinking? Raised at $29 million valuation, you know, not so long ago. Not interested in selling at 700 plus million. It sounds like, you know, if you tell this to most people, it's a surprising decision to just walk away and not negotiate. But when you actually do this, you actually start to understand. It like makes perfect sense.
Jiro,
Yeah.
just a really quick question. I know I keep asking questions along a similar theme, but the reason why we say this is conditional on success is because we're solely using companies that IPO'd, and therefore, and because we're using data from companies that solely IPO'd, and that is the definition of success. And
well,
we're rationing down that
actually
IPO.
a super success.
Pardon me?
That's the definition of super success, which is why we had to adjust it down with acquisitions, which brings us to a more representative measure of success.
But both are still kind of successes. We're not considering any companies that went bust.
No, well, we do, but only when we do the VC method step. Because remember, the value of D that's really big is accounting for failure. That's the reason why the D is so big.
Okay. Right.
There is an elegance to this whole thing.
Right. But the VT we get is only on, that is assuming success.
The VT, right? The exit value is only conditional on success. We only incorporate failure once we bring it to V0 via the VC method.
Got it. Okay. Thank you.
No problem. And again, I just want to emphasize the elegance of it all. The reason why we're going exit value conditional on success is because it's most easy for us to forecast revenue conditional on success, because we end up relying on data points that we can observe, which are data points conditional on success. That's the SaaS IPO data. It's all well designed to chime together in a way that is more rigorous than it seems. Sound good? Shall we do our last Dropbox valuation? All right, let's go ahead and do that. You guys see my slides again? By the way, a lot of what I explained in terms of my logic for doing this valuation, I explain in words in slide 18 out of 26 here. Okay, so, you know, I'm not going to talk about this in class right now, but this rehashes what I said in words. Sound good? Now let's go to our last Dropbox valuation. I've got a few valuations here, but I'm just going to zone in on the most important one, which is we're going to do again an exit comparables based value. It says current comparables based valuation here. I'm literally not going to talk about that right now. Okay. I'm going to skip it. It's not going to be something on the exam. It's actually kind of easy. I just don't have the time. Instead, I want to focus on the exit comps because that's what's more unique to VC. And that exit comps is going to be just another version of our exit comparables based valuation conditional using bottom up. Okay. But I'm going to be actually making an important point here. It's like a point that kind of personally blows me away. I can't believe how well this works out in terms of explaining the real world. But this is actually the next time that Dropbox raises money. It's in October 2011. They raise what is called their Series B. Okay. But that's because they were doing so well, they were able to skip around. So even though this is called a Series B, Dropbox at this stage is more like a typical Series C. Folks okay with this? Let me just go jump into the numbers, okay? I'm going to pop off of this slide and I'm going to show you guys my spreadsheet. So I'm skipping. So I have two things. I have a current multiples-based valuation, which looks more like a valuation you would do for a mature company, where you use as your current valuation data a recent financing transaction where Box raised money at a known valuation. You don't need to know this for this course. I'm not going to test you on it. I want to focus on the exit multiples valuation because that one is just it. To me, it's a great example that I hope convinces you that what I'm saying is legit. Okay. So exit multiples using SaaS data. I've got a growth rate average for SaaS sample, and then I've also got growth rate last 2 years before exit of top half SaaS sample. I'm actually not using these numbers in my valuation. 3 years to exit. You'll notice this number changed. The reason it changed is we're not 2 years later. Since we're 2 years later, I'm now using an extra 2 years worth of data. So I'm updating things every step of the way to use the most recent data at the time that this shit is going down. Okay? So that new updated data is 112%. Are we okay so far? I'm just going to do something pretty easy here. I'm only going to assume 3 years at this 112%. By the way, at this stage, Dropbox, it's been also another good 2 years. Their revenue run rate is now 135 million per year. If they grow at another 112% for the next 3 years, they are at a $1.3 billion revenue when they're going public. So far, so good? I multiply that by the new multiple for SaaS for the top half of the SaaS sample. That multiple has gone up actually because people are getting more and more excited about SaaS. It is now 11.73. That's from the real data. Multiply those two together, exit value, 15.2 billion conditional on IPO. Folks, okay with this? But remember, that's the grand slam. We need to adjust for acquisition. Turns out acquisitions post Series C are also 40% the size of IPOs post Series C. So take 40% of this, that's 6 billion. Probability weight, once we get to Series C, it's a higher chance you're going public, baby. 45% versus 55%. So 45% of this, 55% of that, that's an average exit value conditional on success of a bit over $10 billion. Are we okay with this so far? Plug this into the VC method, $2.715 billion. Guess what? Dropbox has $25 million in cash and they're raising $250 million. So after they raise money, how much money do they have? $275 million, correct? Add $275 million to this number, you get $3.99 billion. You know what Dropbox raised money at? They raised money at $4 billion. That's how close we got. No, there's no cherry picking in anything I did here. Everything I did was reasonable. This is legit how this valuation was justified. We got within $10 million. I mean, I've never had something come up this close in my life. 3.99 billion. Now you might be like, you know what, Jiro, you were really highly motivated to make this look good, right? You know, it's your friend's your friend's company. Like you did no, I don't believe you, Jiro. You're full of shit. Fine. You know, let me try to dispel that myth. Because I'm going to do something else. You know what? I said there's a lot of companies in this domain. Dropbox isn't the only company there at this time. I'm going to do something else. Dropbox is like the high flyer in this industry. I'm going to pick a low flyer. The low flyer I'm going to pick, it's actually the only other company that I can find transaction valuation data for. It's the only other one I can find it for. So again, I promise, if you believe me, you know that I'm not cherry picking now. It's a low flyer, but it's actually called High Tail. High Tail, 56 million in revenue, 34 million, 5 million in cash, 34 million raised. They're a low flyer. They're struggling. They're struggling for a few reasons. Like, they're earning way less revenue per user than Dropbox, and their growth rate is stalling a bit. They're still growing fast, but it's stalling. It's not hyper. They started before Dropbox. And well, they started before. They do have a good number of users, but on their 43 million users, they have 56 million in revenue. Dropbox is 135. Dropbox started later. Little side note, at least one of the founders of High Tail is a McGill grad, and two of them are Montrealers. I'm not saying anything about correlation. Correlation is not causation, let's be clear, right? But there is a McGill connection here. I don't know the people. It's a bit of, anyway, I won't go into the details there. But I will go into the details of evaluation, where I do the symmetric thing to what I did for a high flyer, for a low flyer. What do you think the symmetric thing to do for a low flyer is? Growth rate, instead of the average of the top half, you go average of the, drumroll, bottom half. And instead of taking the average multiple of the top half, you go average multiple of the bottom half. Does that seem like a fair symmetry to impose? Yes or no? So if I take 56 million in revenue right now, grow it at the average of the bottom half, which is 35.8%, that gives me to the IPO number of 140. The average multiple for the bottom half is 4.92. Multiply those two together, average IPO exit value is 690 million. Take 40% of that, 276 million. That's acquisition. Probability weight using the same numbers, 462. Plug into the VC method, 168. Add 5 million plus 34 million. So add 39 million, 207 million. I now have a valuation for High Tail, 207 million. You know what they raised money at? 240. That is damn fucking close. So if you think I'm good enough to cherry pick something to achieve both those means at once, you must think I'm a very good creator of things, because I couldn't do that. Like, this should actually be pretty good proof that, like, this is, like, actually usable in the real world, and that, like, people actually do something that somewhat resembles this. Yeah. So, by the way, what are some of the lessons that we learn here? Some of the lessons that we learn here are actually, because, like, these are wildly different valuations, right? Like, the difference between the low flyer and the high flyer, low flyer, high flyer, is supremo, right? It's like a mega difference, because they have roughly the same revenue. And one of them we're saying is worth 207. The other one we're saying is worth 3.99 billion. Most people who haven't thought about it would be like, what the hell are you talking about? But we've justified it. By the way, there's something that we learn here as well, and this actually governs a lot of things that I do, which is, even though Dropbox is better than anything we've ever seen before in terms of their growth trajectory, notice that the narrative we plugged in for the future is not the best ever. We did average of top half. It doesn't sound crazy, but it gets us their valuation. Meaning, it's pretty obvious. Even if Dropbox is the best ever, a VC is not going to price them like the best ever. They're at most willing to price them as average of the top half. To me, that's a very illustrative observation, because it means even if you're doing crazy, crazy good, we're not going to apply the same crazy, crazy good in the future, no matter how much we want to invest in you. Because trust me, people are lining out the door to want to invest in Dropbox at this time. So you've got all this competition from VCs, and yet they're still not going to plug in a narrative above top average of the top half. That teaches me a lot. It teaches me that if I'm advising a startup, I better not go too cowboy with my narrative. Because if I go too cowboy, I'm going to hurt my customer in the eyes of the VC. And that's not good for my customer. This is useful to know. Because some people might actually try to plug in the best ever. And that would be a mistake. You would lose all credibility in a negotiation. So far, so good. And the flip side is, if things are going really bad, you can still hope to at least be priced like the, but you can be priced as like the average of the bottom half, not as the worst ever. A little bit, people are willing to grant you a little bit of mean reversion. Actually, the market granted them even more mean reversion, 240 instead of 207. By the way, this transaction actually occurred. Didn't work out well for anyone because this company, got sold off pennies on the dollar. Right? But that doesn't mean that this was wrong in the first place. It just means, bad luck happened afterwards. And there was bad luck that happened afterwards. You guys can actually do a Google search on High Tail. There's actually been some stuff written about the company that's interesting. And I'm pretty sure that what I told you about the McGill connection is actually true. I mean, that's what I haven't read the article in many years, but I vaguely remember that. Again, correlation, not causation, okay? Let's be clear. Any questions about this? I don't know. I honestly, this is like my penultimate, okay? Of I'm proud of this one. Because it actually, I think it's a pretty compelling argument. And I feel like it actually delivers more practical value than a lot of, it's probably the one that I'm proudest of out of all of the teaching things that I've done in my life. Yeah, I mean, when I showed this to Sujay, he was like, oh, wow, that's cool. It's not like Sujay had done this, right? The High Tail, specifically, right? So we've got 10 minutes left. There's just one other thing that I really want to talk about. Or one small collection of things that I want to talk about. Let me just go. Am I big now, or you guys see my slides? I'm big right now at the moment.
You're big.
Yeah, so that's not what I want. Okay. There we go. Now you guys can see my slide again. Yeah. Okay, good. I'm not going to talk about this whole slide. I'm going to talk about the first part of this slide. The second part of this slide, I'm just kind of not going to cover this year. It's secondary importance. But I want to point this out because this is something that's important to know, which is what if the market is mispriced? Because you need to remember, this is the most important thing to remember. Whenever you do anything that is comparables-based valuation, regardless of whether it's exit comps or current comps, you are using prices in the market to price you. If the stuff in the market is overpriced, you will overprice you. And if the stuff in the market is underpriced, you will underprice you. So your valuation is only a good fundamental valuation if the stuff in the market is fundamentally valued. It's important not to forget that. Right? Comparable-based valuation is a relative valuation. Validity requires efficient markets. So if things are mispriced, be careful. By the way, I have a video here. This is Keith Rabois. Well, it looks like it's a French name, so I say Rabois, but I don't think he says Rabois. I think he says Rabois. like great startup operator, startup founder, and VC. He's literally succeeded at literally at everything he's done. Good for him. Actually, he's a very interesting guy. So if you click on this clip, there's actually a really interesting segment of a video that I saw recently. Because this is a video that's from this year. I added it to my slides just before I posted these slides. And he actually says something that's really good in the context of this discussion. And I'm going to paraphrase him. So you can listen to what he says. You can listen to what I say and decide whether I'm saying the same thing. Okay? But I'll tell you the way that I want to say it because it links better to the way we've discussed stuff. What if the market is mispriced? Let me ask you guys a question. Is anyone in this room right now a little bit worried that markets are overvalued right now? If yes, just give me a thumbs up. Wait, no one is worried? One person, two, okay. Yeah, you see, so at least 3 people are worried that things are that things are frothy in the market, right? 4th, right? So would you be a little bit worried to price a company that's gonna go public maybe in 7 years with the multiples right now in the market? Would you be a bit worried, and why?
No, is this actual question or is it like a?
It's a question. Yeah, no, it's a question.
Well, like markets go up over time, so if things are slightly overvalued now, I actually wouldn't be that concerned because assuming the market goes up.
Let's be clear. We're using market prices to get a multiple. What you're saying is prices go up, but the reason prices go up is because revenue goes up, right? It's about the attribute. It's not about the multiple, right? And so I'm asking, are you worried that multiples are too high right now? In other words, would you be worried to use the multiple in the market right now as an exit multiple for a company in 5-6 years?
Yeah, I'd definitely be worried.
Definitely be worried, right?
Yeah.
Why would you be worried? Would you be worried that, oh, fuck, I overpaid for this?
Yeah, exactly. And then when you try to exit, multiples will go down.
Yeah, exactly, right? Would you be as worried if I told you the company's going public in 1 year?
Less so, because I think there's going to be less change, but still worried.
Still worried, but less worried, right?
Yeah.
So this is what Keith Rabois says, and I actually believe this. And actually, we'll talk with Jack tomorrow, and I'm sure he will say the same thing. When you are worried about the market like this, and you invest early stage, you probably don't want to price the stuff you're investing in using the current frothy multiple. Instead, you'll focus on more of a historical multiple. Because you're like, historically, the multiple's been lower. I expect in 5 years the multiple to be lower. Does that make sense so far? Meanwhile, if you're a late stage investor, you'll be more willing to use the multiple in the market right now. Because even though you're like, yeah, the market might correct, you're hopeful that you'll be able to exit before the market corrects. Does that make sense as well? And what does that mean? The late stage fluctuates way more in valuations than the early stage. So early stage multiples, they fluctuate less with what's happening in the market right now, because we tend to use data over longer horizons to get our multiple, our target exit multiple. Meanwhile, for very late stage, because everyone is like, whatever, this might be mispriced, but I'll get in and get out quickly and get my 2x. Because investors say that, they're more willing to start bidding aggressively high, especially if they think a company is just pre-IPO. Then they'll be willing to bid it up using the current multiple. And if you look at the market right now, the market late stage right now is nuts and frothy to the point where people aren't worried about investing. Like, I am sure that, well, I'm not sure. Okay, Jack may not admit it in a recording. He did say it's okay to record. But if you asked him off the record, I'm sure he would say, I'm a little bit worried. He may not acknowledge it. It's not a popular thing to have on record, right? So, one needs to think through that. But like, He's a pretty open guy. He's pretty secure with his reputation. So he may be a relatively open book. I'm not sure. We'll see. And I'm pretty sure actually right now he's more focused on making investments that are really, really close to IPO. So he's maybe not doing the early part of the late stage, and he's focusing more on the late stage. That's my guess. We haven't talked about it, but that's my guess. That's what I would do if I was him, to be honest. Meanwhile, the early stage is going to fluctuate less. And actually, the Keith Rabois article explicitly says that. He says, look, late stage moves more with the market, early stage less so. And the moment you see the early stage moving with the market, that's when you start getting worried about being an early stage investor. If I'm an early stage investor and the early stage is moving with a frothy market, I am out. I am taking a little break. I'm focusing on the companies I already invested in, and I'm not looking at making new investments as much. And that's that. That's basically all I wanted to talk about for comps-based valuation. So I hope you guys found it useful. What we're going to do, albeit it's going to be in a recording, so it's not going to be in a live session like this, is probably over the weekend, to be honest. I will post a lecture where we do a streamlined version of DCF-based valuation for startups. But actually, let me be 100% clear. VCs, almost all of their valuations are comps-based like this, as opposed to like the versions of DCF that I'm going to, or the single version of DCF that I will teach you guys in the next asynchronous class. Sound good? All right. I hope everyone has a nice evening. Nice additional video viewing over the weekend or early part of next week. And I will see you guys next Tuesday. And next Tuesday, I'll have to look at the calendar, but I think it's next Tuesday. We'll start topic 3, which is the last thing. Topic 4, which is going to be the last stuff we do in this course. That's going to be about deal structuring, which is basically term sheets, the agreement between the startup and investors. And then we're going to start thinking about not just valuing a startup as a whole, which is what we were doing here, but thinking about how the value of the startup gets split across different stakeholders, all the different VCs, the founders, the employees, right? We'll figure out how that yummy little pie is split across different people, because that's relevant, because you want to know what's the value of the thing you own. And it can be a little bit complicated, and it's going to involve doing some stuff related to derivative pricing. So I will cover that over the last stretch of this course. Sound good? All right, have a good evening, everyone.